Today, we're going to tackle one of the biggest, most fundamental beliefs in the world of investing. The idea that owning stocks is your golden ticket, your surefire way to protect your wealth from the ravages of inflation. So, let me ask you a question. When you see those inflation reports and the numbers are ticking up, do you get that little sense of comfort, that warm, fuzzy feeling because your money's in the stock market? It's a really common feeling, but we're about to find out if it's actually built on solid ground. You know, on the surface, the argument for why stocks should beat inflation, it seems perfect. It's simple, it's intuitive, it's airtight. But as you're about to see, when we dig into the actual data, the real history, well, the reality is a whole different story.
So before we just go and bust this myth, I think it's really important to understand why it's so powerful to begin with. What makes this idea so darn convincing? Why do we all kind of fall for it?
Okay, so here's how the thinking goes, and you'll see why it feels so right. Step 1, inflation kicks in. Step 2, companies just pass those costs along, right? They charge more for their stuff. Step 3, higher prices mean more revenue, which means bigger profits. And step 4, bigger profits, of course, mean higher stock prices. It's a perfect chain reaction. It just makes sense, doesn't it? But is it really that simple?
And this is where our story gets really interesting. Enter the legend himself, Benjamin Graham. Now, he saw everybody just nodding along, accepting this simple logic, and he decided to do what all great investors do. He actually checked the receipts. He put on his detective hat while everyone else was just following the crowd. So Graham zoomed in on this 20-year stretch, from 1950 to 1970. And this wasn't some quiet period, folks. Wholesale prices shot up by almost 40%. I mean, this was the perfect real-world lab to test this theory. If stocks really were an inflation hedge, investors during this time should have been absolutely swimming in cash.
And here's the plot twist. After digging through 2 decades of hard numbers, Graham drops this absolute bombshell. He found that all that inflation, that 40% jump in prices, provided, and I'm quoting here, virtually no benefit to common stock investors. So, what on earth went wrong? What broke that perfect logical chain?
All right, time to put on our detective hats. We're going to investigate the scene of the crime and uncover the hidden economic forces, these powerful headwinds that were blowing against investors and completely canceling out any help they were supposed to get from inflation.
And, whoa, look at this. This is clue number 1, and it is a big one. Between 1950 and 1969, corporate debt didn't just go up, it went through the roof. It nearly quintupled. But profits? They just kind of plodded along, barely doubling. That massive gap you see, that is a huge flashing red light.
So what explains that scary gap between soaring debt and sleepy profits? Well, it turns out there were 3 main culprits working behind the scenes, basically sabotaging company profits even while they were charging higher prices.
Let's name them. Culprit number 1, rising wage costs. As prices went up, workers needed more pay, and those wage hikes started growing way faster than productivity, which squeezed profits. Culprit 2, surging capital requirements. All of a sudden, companies had to spend way more money on new equipment in factories just to produce the same amount of stuff. And culprit number 3, as we just saw, that exploding corporate debt meant higher and higher interest payments that were just eating away at the bottom line.
Okay, so that was Graham's finding back in the 70s. But here's the crazy part. People still believe this myth today. So why? Well, let's fast forward a few decades because commentator Jason Zweig gave us the answer. And it turns out it's all in our heads.
The culprit is a sneaky little cognitive bias called the money illusion. It's this glitch in our brain's operating system where we get fixated on the number printed on the money, its face value, instead of what that money can actually buy, its real purchasing power. And this little glitch has massive consequences.
Let me show you how this messes with us. Imagine you get a 2% raise. Feels good, right? Your paycheck is bigger. But if inflation is running at 4%, you've actually lost ground. Your purchasing power went down. You're poorer. Now, that's the exact same result as taking a 2% pay cut when there's zero inflation, which would feel absolutely terrible. Our feelings are betraying the math.
And this is not just a theory. Check out these wild but real numbers. Back in 1980, people were absolutely delighted to get 11% interest on a CD. 11%! But inflation was over 13%. They were literally losing money but felt rich doing it. Now compare that to 2003. People were disappointed with the 2% rate, but they were actually just breaking even. It's crazy, right? That is the money illusion in full effect. Okay, so we've diagnosed the problem. We understand the psychological trap.
Now for the good news. We are not stuck in the 1970s. We have specific investment tools designed to fight inflation that Benjamin Graham could have only dreamed about. So let's open up the modern toolkit.
We're going to zoom in on two of the big ones. On one side, you have TIPS, or Treasury Inflation-Protected Securities. These are government bonds that are basically hardwired to fight inflation. On the other side, you have REITs, or Real Estate Investment Trusts, which give you a piece of the action in real, tangible assets like buildings and land.
So let's talk tips. What's the deal? Well, the huge pro is safety. They're backed by the US government, and the protection against inflation is guaranteed. It's right there in the name. Zweig even suggests putting at least 10% of your retirement money here. But, and listen up because this is a really important but, the inflation adjustments you get are taxed every single year. That makes them a much better fit for a tax-sheltered account, like an IRA or a 401k.
Now, what about REITs? Think of it like being a landlord without the late-night phone calls about a leaky faucet. You own a piece of a big portfolio of properties, apartments, offices, malls. The beauty here is that when inflation goes up, rents often go up too. It's a natural hedge. Plus, they're liquid, you can sell them like a stock. The trade-off? You don't get to pick the properties yourself, and they can get knocked around when interest rates change.
Okay, we've gone through the history, the psychology, and the modern tools, so let's bring this all home. Let's synthesize all this wisdom into a practical, no-nonsense playbook for the intelligent investor who's facing inflation today.
And you know what? This single chart right here, this is the whole ball game. This is the key. It turns out that not all inflation is the enemy. When inflation is low, maybe even moderate, stocks actually do pretty well. But the second it gets hot, and you see it right there, when it crosses that 6% line, bam, stock returns just fall off a cliff. So it's not just inflation, it's the level of inflation that matters most.
And just how bad does it get in that danger zone? This one number tells the entire story. 2.6%. In all the years studied, when inflation was raging above 6%, that was the average real return from stocks. 2.6%. You are barely treading water. This is where the whole stocks are an inflation hedge myth completely shatters into a million pieces.
So what's the playbook? What do you do? Here are 4 key takeaways. Number 1, always focus on your real return after inflation. That's the only number that matters. Beat that money illusion. Number 2, question everything. Be like Graham. Don't just accept the common wisdom. 3, diversify your defenses. Don't put all your eggs in the stock basket. Use a mix of quality stocks, but also those other tools like TIPS and REITs. And finally, number 4, watch the debt. If you see corporate debt piling up today like it did back then, that is a huge red flag.
So we'll leave you with one final question to chew on. Take a hard, honest look at your own investment strategy. Is it really built on that timeless, data-driven wisdom of people like Graham? Or could you just maybe be caught in a very comforting but very dangerous money illusion?